What if I told you it's completely legal to pay zero real estate taxes in Canada and CRA is actually okay with it? Sounds too good to be true, right? Well, it's not. There are three powerful strategies that you should do legally to make your real estate taxes zero. Before we jump into the hacks, let's understand how CRA calculates your taxes. Because understanding this formula is the key to reducing the taxes. Capital gain equal to selling price minus outlays minus adjusted cost base. Selling price, straightforward, the price you sold your property for. Outlay expenses, basically these are the expenses you pay to sell your houses, like real estate agent fee, bank mortgage fee or early discharge fee, advertisement cost, staging fees, the traveling related to the real estate sale, the utilities and the bills you pay while you're trying to sell the house. These all are the expenses that reduce your capital gain. And adjusted cost base, this is the real cost of your purchase. So your purchase price plus land transfer fee plus legal fees plus the title search you did at the time of purchase plus any major renovation or repair you did to improve the value. Once you know how CRA calculate your gain, you will realize the magic isn't in avoiding the taxes. Rather, it is in understanding what counts as a cost. Let's see how to turn legally your gain to the zero. So let's calculate the capital gain and the taxes. Let's say you bought a house for 500,000, you did the renovation for 100,000 and you're selling it for $1 million. And all the selling cost is equal to $100,000. So as per this, capital gain becomes 300,000. Now the CRA is changing the capital gain tax rules from January 1st, 2026 onwards. They are bringing a new inclusion tax rate. So let's understand before and after picture. Before, the current scenario is 50% of the capital gain is tax free, 50% of that income will be added into your income and taxed at a slab rate. So out of the $300,000, 150,000 is completely tax free, take it home. Another 150,000 is taxable, that will be added into your income. And if you and your spouse own it 50-50, it becomes $75,000 your income, $75,000 wife income. But CRA is implementing a new rule that will include 67% after 250,000. So for the first 250,000, it is basically still 50-50, 125,000 exempt, 125,000 added into your income and tax at slab rate. On the next 50,000, that is 300,000 minus 250,000, the 50,000 part, 67% of that is added into your income and tax at a slab rate, and the remaining 33% is tax free. So here is the side by side comparison. If you don't have any income, what would you pay in capital gain before and after? Most Canadians don't realize that you can sell your house for millions and pay literally zero taxes, and here is how you do it. The principal resident exemption let you make capital gain zero on your primary home. There is a caveat to it. If you rent your portion of the house, such as basement, then that particular portion becomes taxable. Even if you own multiple properties, you can still choose one as a primary home for a particular year and you can maximize the tax saving. Here is where your CPA becomes very useful. So before you rush to sell your house, talk to your accountant. It can save you thousands of dollars by designating the right property as principal home. Here is little known secret. CRA lets you use tax losses as a shield against your capital gains. So here is how you can do it. Let's say you want to sell your rental home for a profit. Consider if you have any stocks, debentures or any other house that is in the capital loss. You can actually realize the capital loss and set it off against this particular house. So you basically pay zero taxes. And the good thing about loss is you can actually carry back 3 years. Also, you can carry indefinitely. In the next year or next to next year, let's say you have a capital loss in the stock market. If you realize that loss, you can actually carry back and apply to the 2025 year. So whatever extra taxes you are paying right now, you will get refund at that point of time in the future. One more thing you should consider very seriously is to keep your receipts and bill for the renovation. So the major renovations and repairs improve your adjusted cost base and in turn that reduces your capital gain. So we already know what is the capital gain in the personal capacity, right? But is it really better to own under the corporation? What's the difference between personal real estate and corporation real estate? Like what are the pros and cons, right? So I'm making very detailed video on it. Make sure to subscribe so you get the notification. Owning a real estate under your corporation can be really powerful. It gives you limited liability, better refinancing option, and long-term wealth planning. But here is the catch. If you move your asset too fast, too soon into your corporation, you might get hit with unexpected capital gain taxes as well as land transfer taxes. That's where the Section 85 rollover comes into the picture. It's CRA's own legal way to transfer your personal asset into the business at a higher value without triggering any capital gain. Basically, it lets you defer the capital gain, so you don't pay right now, you pay later it when your corporation sells the property. It's best for the long-term investor, assets protections, as well as bringing in new partner before restructuring. But it's not for everyone. If you do it without the proper structure, you might get hit with the proper capital gain taxes. So before you rush to open a new company, make sure to watch this video so you don't make this #1 mistake all the people do. It will save you a lot of headache and thousands of dollars, and your corporation will be the right way.